Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. Today, I just wanted to demystify some financial jargon for you. Um, Three phrases we'll take on, and I'll describe what they mean. First one is asset allocation. People get flummoxed by that. What does that mean? Really, that's just a fancy way of saying what percentage of your money is in stocks, what percentage is in bonds, and what percentage is in cash. That's all that means. That's all asset allocation means. So if someone asks you what your asset allocation is, that's what they're asking you. By the way, most people don't know what their exposure to those three asset classes is: stocks, bonds, and cash. And you should, and your advisor should be telling you. And investment grade bonds don't fluctuate that much. They had a bad year in 2022. They don't move around that much. They're in general, they're supposed to be ballast in your portfolio. So the real question is, how much stock exposure do you have? That's the asset class that will make you crazy. It goes up and down a lot. It has a lot of volatility, but it also produces better returns over the very long run. So what's your asset allocation means? What's your exposure to those three main asset classes? And it really means how much stock exposure do you have? Okay, number two, what is dollar cost averaging? That sounds like a really complicated thing. It's not. It means adding a little bit of money to typically stocks, but it can be any investment over a prearranged period of time. So let's say you've come into an inheritance and you want to put it to work, but you're kind of afraid to put it to work all at once. So you space it out over a year, over 18 months, something like that. That's called dollar cost averaging. So pretty simple concept, fancy word for something that anybody can understand. Third thing is, what's the difference between an ETF, an exchange traded fund, and a mutual fund? Here, it is a little bit more complicated, but it's not that bad. Let's start with a mutual fund, actually. That's kind of the older technology. A mutual fund is where you and a bunch of other investors pool their money into a vehicle that's registered with the SEC. That vehicle has a manager, and the manager takes everyone's money and invests in stocks or bonds or both. And so you can generally get greater diversification in a mutual fund than you can on your own. That was one of the main reasons for its invention. There's also a fee, of course, associated with that. There's a management fee typically. There are passive funds and active funds. Passive funds are index funds. They track an index. So there is a manager, but the manager isn't doing very much. And so the fees are typically low. Your objective is just to try to match the return of a particular index, something like the S&P 500 or the global stock market, whatever it may be. So that's a mutual fund, and that's the difference between a passive and an active mutual fund. A mutual fund also has one price every day at the market close. It tabulates the prices of all the securities it owns, and it comes up with a price of its own shares. And so, for example, it's Sunday night right now as I'm recording. If I place an order to purchase a mutual fund, that order will go through at 4 o'clock tomorrow, Monday. So I'll get tomorrow's 4 o'clock price. Similarly, if I place an order now to sell a fund, I will also get tomorrow's 4 o'clock price. Whatever the securities the particular fund owns will be priced, and I will have my shares purchased or sold, depending on my decision. An ETF is different in that it trades throughout the trading day like a stock. It also doesn't actually own the securities directly. It owns a basket of the securities, and so it goes through what are called creation and redemption baskets. Um, that sounds weird. It really isn't. It's a kind of proven mechanism at this point, but the advantage to it is that when the ETF trades, there are seldom taxes involved. And so an ETF is a more tax efficient vehicle than a mutual fund. And most of the time, it probably should be used more for taxable accounts, that is, non-IRAs. It is a little bit weirder in how you trade it because of the fact that it trades throughout the trading day. So I wouldn't want to put an order in now on a Sunday evening for an ETF, or I would want to maybe do a limit order, but that would be something a lot fancier than a plain market order, which I wouldn't want to do right now. Market opens can be weird. And so ETFs are harder to trade. They're a little bit harder for the individual investor to trade and to invest in, for the reason that they trade it every minute of every day. A mutual fund is much easier. You're typically making an investment for the long term, and you should be making an investment for the long term in an ETF as well. But the trading is a little bit funkier. And so I'd caution against you're doing it. If you've never done it before, do it with a very little bit of money to get the hang of it if you're intent on doing it. But otherwise, you might want to leave that. You might want to leave that to someone else. But there are real tax advantages to an ETF, to an exchange traded fund over a mutual fund. So that's it. Those are the three concepts: asset allocation, dollar cost averaging, and the differences between a mutual fund and an ETF or an exchange traded fund. For now, this is John Kamarianos for Capital Considered, signing off. Thanks for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.